Hello everybody, today we're going to talk about capital leases versus operating leases. I'm here with Andrew McMillan. I'm Ray Halstead with REH CPAs. Andrew, a lot of the questions that we get from small business owners, whenever they go to buy a big piece of equipment or an automobile, and they say, hey, should I, I'm going to do this lease, but what is the difference between a capital lease and an operating lease?
Yeah, it's important to understand the difference because there's two different tax treatments on which type of lease it is. So if it's an operating lease, it's really just kind of how the name says. It's just, you just use it in your normal operations with the business. You're deducting those rent payments directly off of your profit and loss. It's a true rental. You don't own it. You don't take possession of it after the end of the lease. It's just you're truly renting that piece of equipment. I kind of like to use a vehicle example. Like a lot of people have leased vehicles before. You pay some money down. You pay $500-600 a month from there on out. In that example, it would all just be deductible expenses as you're paying it. There's not and at the end of the lease, you usually have like a fair market value purchase option at the end of it. So those are all operating leases.
Right. You lease a car for and the value of it's 30 grand when you lease it, and then at the end of the lease term you can buy it 15. Then you're just basically renting that vehicle.
So on the flip side of that, some leases are what's called capital leases or even financing leases. Those are kind of two of the same terms there, but capital leases are, you kind of have the optics around it are like you've purchased this actual piece of equipment. So there's a couple different rules that
they call it a lease, but it looks like a purchase.
Yeah, there's a couple different rules that they put you into. So like if your lease payments are more than 75, or the term of the lease is more than 75% of the asset's useful life, then you've pretty much bought that piece of equipment and you record it as a capital lease. Right. If the present value of the lease payments is more than 90% of the asset's cost, then the IRS views you as purchasing that piece of equipment. Right. Probably the one that we see the most is there's a bargain purchase option at the end.
That's pretty much the easiest one. Usually I go right down to that one. Hey, how much do you have to pay for this thing whenever you get done at the lease? Do they just give it to you? Is it like $1? They say yes. I think, capital lease.
You see it as $1 a lot.
And it's pretty much, it makes sense because then it's pretty much they're financing it for you over that period of time. So it's basically like you purchasing it.
Exactly. So if there's that bargain purchase option for $1 capital lease, if there's a fair market buyout at the end, then it's an operating lease. But the capital lease, you treat those really just like you purchased it, like you just said. So you put it on the books as an asset and you depreciate it. So
you can take accelerated depreciation. You can do a bunch of different things with depreciation.
Yeah, we've done some other videos on writing off assets and stuff. So you can actually, even if you've got a loan or you've got this lease that you have to pay, they view it as if you bought it with a loan.
Right. So, and if you're doing the bookkeeping on this, or you're trying to record it in your accounting records, the difference between how the two will look. An operating lease is just going to be a monthly lease payment. That's all you're going to see. You're going to have rent or equipment rental or lease as an expense on the P&L. But if it's a capital lease, it gets recorded like you acquired an asset, like you purchased one. You're going to have an asset up in the asset account. Let's say it's a backhoe. You're going to have a backhoe up there in the asset account, and then you're going to have to do the lease liability down as a liability payment. And there's some work that has to be done to try to figure out how much of that lease payment is considered interest and how much of it is considered principal. But your CPA can absolutely help you with that.
Yep. So you just write it off just through depreciation, and just two different ways of looking at it. Yep. Usually capital lease is a little bit better because it gives you some more options to write it off quicker if you want. But anyway.
No, that's a pretty good explanation. We run into all the time, especially with our construction guys. They're constantly leasing equipment and things like that. So, no, really good explanation, Andrew. Again, this is Ray Halstead. I'm with Andrew McMillan with REH CPAs. If you like this video and you'd like to watch some more, go to our YouTube channel, hit the notification button to be notified whenever we put out a new video. But we appreciate you guys watching. We'll talk to you soon.